Hi, John Taylor, investment banker, coming at you with a video on business valuation. So we recently did a business valuation on an insurance brokerage and agency business. This was a company do about $1 million in sales, and in every business valuation we do, we include a write-up on the industry. And as you can see, up to 2017, this is a business about $160 billion industry, 3.7% growth rate. So pretty good. I mean, financial services, tends to be a fairly strong industry, decent growth rate. So this includes personal as well as commercial insurance agencies as well. But kind of the meat of the valuation, what I want to show you is down here. So this comparable merger and acquisition transactions, this is really, I think, the simplest and easy way to understand valuation. So, I mean, if you think about selling your house, or if you wanted to appraise your house, I mean, the easiest way to understand the value of your home would be to look at other homes in the neighborhood and what they sold for on a dollar per square foot basis or otherwise. So similarly, what we do in valuing this insurance agency, we looked up transactions of other insurance agencies around the country, and these are both personal and commercial insurance businesses. So we found about 20 or 25 transactions here going back over the last 3 years, and the kind of value range. I mean, these were all companies that were did anywhere from $100,000 in sales to just over $2 million in sales. So this company did about $842,000 in sales in the last year or so. And if you look at owner discretionary earnings for this company, it was about $352,000. So this company is doing, probably around 40% owner discretionary earnings margin or profit margin. So that's fairly good profitability for a small business like this. And you can see, I mean, if you look at, for example, so this MVIC divided by discretionary earnings, basically that means the market value of invested capital for this business. So that's the value of all the debt and the equity in this business. Or, I mean, really, you just think about, I mean, it's just a fancy way of saying, like, that's the purchase price of this company. That's what this company is worth, its value today, what it would sell for in the current market. And typically these companies trade at a multiple of their owner discretionary earnings. So as you can see, I mean, the median multiple in this case is about 3.4. So we take that 3.4, we multiply it by the company's owner discretionary earnings of $352,000. That gets us to an implied enterprise value of $1.2 million. So enterprise value, that's the purchase price, that's the value of all the debt and equity in the business. Now, to get to the equity value in the company, we have to subtract off the debt that the business has. So this company didn't have a lot of debt, about $6,000. So once we subtract that, we get to just under $1.2 million in equity value. So as you can see, I mean, this is a fairly straightforward valuation. We tried to kind of cull this list of transactions. We didn't want to pick out companies that were too large or involved in other types of lines of insurance that weren't comparable to this business. We want to make sure they were involved in personal and commercial and nothing really too unique. So these are all sort of generic, if you could call it that, insurance agencies all around the country. And as you can see, I mean, most of these companies sell within a fairly narrow range of their owner discretionary earnings. So anyway, hope this was helpful in helping you understand more about how business valuation is done. Thank you very much.